Every investor knows about the S&P 500. It is the most referenced index in the world. It tracks the 500 largest companies listed on American stock exchanges, and it has delivered average annual returns of approximately 10% over the long term. Financial educators recommend it. Legendary investors endorse it. Most beginner investing advice eventually arrives at the same conclusion. Just buy an S&P 500 index fund and hold it forever. And that advice is genuinely good advice. But it is not the whole story. Because there is another index, less discussed, less marketed, and almost never mentioned in mainstream personal finance content, that has historically outperformed the S&P 500 over long time periods. And most people who consider themselves informed investors have never seriously looked at it. The index I'm talking about is the Small Cap Value Index, specifically the category of investments that tracks small companies with low valuations relative to their fundamentals, companies that are cheap, overlooked, and historically rewarded by the market over time, in ways that large-cap growth stocks are not. Before you dismiss this as obscure financial theory, understand that the outperformance of small-cap value stocks is not a fringe idea. It is one of the most thoroughly documented findings in the history of financial research, backed by decades of academic study, championed by Nobel Prize-winning economists, and quietly used by sophisticated institutional investors around the world, while most retail investors remain entirely unaware of its existence. To understand why small cap value outperforms, you need to understand two concepts: the size premium and the value premium. The size premium refers to the historical tendency of small companies to generate higher long-term returns than large companies. The value premium refers to the historical tendency of cheap stocks, measured by metrics like price-to-book ratio, price-to-earnings ratio, or price-to-cash flow, to generate higher long-term returns than expensive growth stocks. These two premiums were formally identified and documented by economists Eugene Fama and Kenneth French in their landmark 1992 research paper, work that would eventually contribute to Fama receiving the Nobel Prize in Economics in 2013. The Fama-French three-factor model showed that over long historical periods, small-cap stocks outperformed large-cap stocks, and value stocks outperformed growth stocks, and that small-cap value stocks, occupying the intersection of both premiums, produced the highest returns of all. The data behind this finding is not from a short or cherry-picked time period. Research examining global stock market returns across multiple countries and multiple decades consistently finds the small-cap value premium appearing in market after market, in the United States, in Europe, in Japan, in emerging markets. The premium is not confined to one country or one era. It appears to be a structural feature of how markets work rather than a historical accident. When you combine the size premium and the value premium, when you specifically target the small companies that are also cheap, the historical return advantage over the S&P 500 has been substantial. Over the period from 1926 to the present, U.S. small-cap value stocks have returned approximately 13 to 14% annually compared to approximately 10% for the S&P 500. That 3 to 4% annual difference compounds into an enormous wealth gap over decades. Before we get started, take a second to like or subscribe to Kraftwise. It's a simple action from you, but it helps this video reach other money-minded people like you. Let me make that concrete with numbers, because percentages alone do not communicate the full picture. Imagine two investors. Both start with $10,000 and both invest for 40 years. Investor A puts their money in an S&P 500 index fund, returning 10% annually. After 40 years, they have approximately $452,000. Investor B puts their money in a small cap value index fund, returning 13% annually. After 40 years, they have approximately $1,327,000. The same starting amount, the same 40 years, the same passive investing approach. The difference is nearly $900,000, produced entirely by the historically documented premium of small-cap value stocks over the broad market index. This is not speculative. This is the mathematical extrapolation of historical return data that spans nearly a century of market history. So why does nobody talk about this? There are several reasons, and understanding them is as important as understanding the premium itself. The first reason is that small cap value stocks are uncomfortable to hold. The premium does not come for free. Small cap value stocks are genuinely riskier than large cap growth stocks in the short term. They are more volatile. They can experience devastating multi-year drawdowns that test the conviction of even experienced investors. The 2000 to 2002 period saw small cap value stocks fall dramatically. The 2007 to 2009 financial crisis hit small cap value particularly hard. Holding small cap value through these periods required a level of discipline that most investors simply do not have, which is partly why the premium persists. If small cap value were easy and comfortable to hold, the premium would be arbitraged away as more investors chased it. The second reason small cap value is rarely discussed is that it significantly underperformed the S&P 500 throughout the 2010s, a full decade during which large cap growth stocks, particularly the technology giants that dominate the S&P 500, produced extraordinary returns while small cap value lagged. This decade of underperformance convinced many investors and financial commentators that the small cap value premium was dead, that the historical data was irrelevant in a modern economy dominated by scalable technology businesses. This conclusion was premature. Following the COVID-19 market crash of 2020, small cap value began one of its strongest recovery periods in decades, dramatically outperforming the S&P 500 between 2020 and 2022 as investors rotated from expensive growth stocks into cheaper value names. The premium did not disappear during the 2010s. It simply experienced a prolonged period of underperformance, which is normal and historically consistent, before reasserting itself. The third reason is that the financial media and the investment product industry have limited commercial incentive to promote small cap value index funds. The S&P 500 is a far more powerful marketing tool. It has universal name recognition. It allows financial product providers to say they offer exposure to the world's most iconic companies: Apple, Microsoft, Amazon, Alphabet. Small cap value funds hold companies most people have never heard of, smaller businesses trading at low valuations, which makes them significantly harder to sell to retail investors who want to feel connected to the brands they recognize. The product that generates the most marketing attention is rarely the product that generates the best long-term returns. The fourth reason is tracking error regret, the psychological pain of underperforming a benchmark you could easily own. When small cap value lags the S&P 500 for a year or two or three, investors feel the specific discomfort of knowing they could have simply bought the index everyone talks about and done better. This regret is psychologically powerful, and it causes many investors to abandon small cap value strategies before the long-term premium has time to materialize. The premium requires patience that extends beyond most investors' emotional tolerance for underperformance. So, how do you actually access small cap value exposure? The most straightforward approach is through index funds and ETFs specifically designed to track small cap value benchmarks. In the United States, the most widely referenced small cap value funds include the Vanguard Small Cap Value ETF, which tracks the CRSP US Small Cap Value Index, the iShares S&P Small Cap 600 Value ETF, and the Avantis US Small Cap Value ETF, which targets a particularly concentrated exposure to the value and profitability factors simultaneously. Internationally dimensional fund advisors, commonly known as DFA, have offered small cap value tilted funds for decades and are widely regarded as among the most rigorous implementers of factor-based investing. These are not exotic or difficult to access products. They are available on most major brokerage platforms globally. The question that most serious investors eventually ask is whether to replace their S&P 500 allocation entirely with small cap value, or whether to tilt towards small cap value while maintaining broad market exposure. The honest answer is that neither approach is universally correct. It depends on your investment timeline, your emotional tolerance for extended periods of underperformance relative to the broad market, and your conviction in the persistence of the historical premium. The approach most consistent with the academic evidence is to maintain meaningful exposure to the total market, capturing the full equity risk premium, while adding a deliberate tilt towards small cap value to capture the additional premiums documented by Fama, French, and subsequent researchers. A portfolio allocated 60% to a total market or S&P 500 fund and 40% to a small cap value fund represents a meaningful tilt without the psychological concentration of going all in on a single factor. It is also worth understanding the concept of factor diversification, the idea that different risk premiums perform well in different economic environments, and that holding multiple factors simultaneously can smooth the return journey even if it does not maximize peak returns. Small cap value tends to perform particularly well during economic recoveries and periods of rising inflation, environments where cheap cyclical businesses regain pricing power and where the market begins rewarding fundamentals over narrative. Large cap growth tends to perform well during periods of low interest rates and deflationary pressure, where the present value of future earnings is discounted at lower rates. A portfolio that holds both captures different parts of the economic cycle rather than being entirely dependent on any single environment. What this means practically is that the investor who adds small cap value exposure to their portfolio is not simply chasing higher returns. They are adding a different source of return that is partially uncorrelated with the returns generated by their broad market holdings. During the years when the S&P 500 is driven primarily by a handful of expensive technology stocks, the small cap value portion of the portfolio may lag. But during years when the market rotates toward cheaper, fundamentally sound businesses, the small cap value tilt will contribute returns that the pure S&P 500 portfolio does not capture. The most important thing to understand about the small cap value premium is that it requires a genuinely long time horizon to materialize reliably. Academic research suggests that meaningful factor tilts require time horizons of 15 years or more before the probability of outperformance becomes high. This is not a strategy for someone who needs their money in 5 years. It is a strategy for someone who is investing for retirement decades away and who has the patience and the temperament to hold through extended periods of relative underperformance without abandoning their strategy. The S&P 500 is an excellent investment that nobody serious about personal finance should dismiss. But the idea that it is the only index worth owning or the best index available is a simplification that costs long-term investors real money. The small cap value premium is real. The academic evidence behind it is among the most robust in financial research. The funds that allow you to access it are cheap, accessible, and widely available. The only thing required to benefit from it is knowledge and patience, both of which are free. Most investors will never look beyond the S&P 500. They will follow the advice that is loudest and most frequently repeated, and they will do reasonably well. But the investors who take the time to understand what the evidence actually shows, who look beyond the marketing and into the research, have access to a historically documented return advantage that compounds into hundreds of thousands of additional dollars over a lifetime of investing. That is the index fund nobody talks about. Click here to watch our video on how much money you need to never work again, because understanding your investment return assumptions is the most important input in calculating your financial independence number.